Hi, I'm Steve Van Metre, and welcome to your Monday Night Premiere, where we take 15 minutes every Monday and Wednesday evening to try to make sense of a market that just doesn't make any sense. Need some proof of that? Well, it's real simple. On Friday, the government did release its data on new home sales, which were down. Market obviously didn't react because they were closed. On Monday morning, today, we find out that existing home sales are down 13 months on a year-over-year basis, on an annualized basis, in a row. The markets rise. Now, that doesn't make any sense of how we can have a booming economy when home sales are falling. So the number of homes sold a year ago, today, they're less. 13 months in a row. And how do you get new all-time highs in stock markets where one of the largest creations or money-creating machines in the economy, new home, existing home mortgages, are dying on the vine? It's real simple. Everyone thinks that this is all going to change in the coming quarters. Good luck with that. The content of this video is provided as education and information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling security, financial product, instrument, or participating in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity and opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So, yeah, I just find it real interesting that so many people are bullish about the economy but can't see what's going on in home sales. In fact, let me, it's not even, it's fun. Let's pull up a chart. Let's do it. Let's look at a chart real quick. There you go. This is from wolfstreet.com. Existing home sales drop, percentage change from same month a year ago. And you can see a lot of red there as number of existing homes sold fall. Kind of not what you're really expecting to see at this point in time, but it is what it is. All right, let's switch over back to the PowerPoint since we have some updated data from Friday. Let's take a look at it. A lot of alarms are showing up here in the money supply. We'll look at that again on Friday. Not a good sign. But look at commercial industrial lending on a year-over-year basis. It's down to 7.5%. I said as this back end number rises, which it is, was like 4.2 to now 4.7, the front end number is going to drop, and it is quickly dropping. So what's showing is what was a very pretty picture on a graph, not a very pretty picture in terms of how much commercial and industrial lending is going on. So this was driving the economy. It is rolling over, and look for it to continue to fall. Consumer loans, credit cards, and other revolving plans, big drop the week before, slight increase to, I'm just going to say it's down. I mean, we're talking, went from 4.05 to 4.12, general trend still down. Consumer is totally tapped out. All right, so today's really light trading volume was due to about 80% of the S&P 500 in a share buyback blackout period. I try to say that 10 times in a row. And if we looked at the biggest buyers of stocks, the only buyers of stocks for the most part have been non-financial corporations. Everyone else, rest of the world, households, institutions, all net sellers. But here's an interesting chart. I don't remember who posted this on Twitter to give them credit, but to whom they are, credit is given. You have the Russell 2000 small caps in cyan. We have the broad S&P 500 in green. And what happens is when these two get disconnected, and you can see they are disconnected right now. The last time they were disconnected, small caps were right, and the big caps came tumbling back down. So we know small caps, among other things, are leading the broad equity market, and the broad equity market is going the wrong way. This, I think, was probably posted on Friday on Twitter. The smart money has been buying volatility, and there's no kidding with that. Commercial hedgers in green, large traders are the dumb money in red, and you can see when the smart money has been buying, you get a volatility spike, and they've been buying as people are shorting. Volatility tells us there is likely a spike in volatility coming in the near future. So what I like to do on Mondays is, now that we're kind of back in a regular setup here is look at how hedge funds are positioned. So this is hedgeopia.com, and you can go down to commitment traders peek into the future through futures, how hedge funds are positioned, and we can see they're maintaining their 10-year treasury. It says here 10-year note. This is in yields on the right. 10-year treasury is, we're seeing further shorting, not much, but further short from a week ago as speculators look to see yields go higher. They're wrong about their opinion on that, but nevertheless, they're still short. They're short 30-year yields. Not much change here after they kind of unwound from their big push back here. Looking at oil, oil is not rising from a demand standpoint. It's rising from a speculative standpoint. And you can see speculators are very long oil all of a sudden, and they think this big reflation trade's coming. They think interest rates are going up. They think the economy is going to boom. And 3 out of the last 4 weeks, we've seen an oil build. Something isn't right here. Whatever they're seeing isn't happening. So when they realize that this isn't happening, they're going to unwind out of these positions. And starting tomorrow, we'll get the API report from the American Petroleum Institute. And then on Wednesday, we get the official government report. Looking at the S&P 500, hedge funds are back net long, meaning they believe the market's going to go higher from here, but they're not overly convicted by it. Looking at gold, big drop off in gold. No surprise. They didn't get the breakout they wanted, and so they're going to be net sellers. This should be, at least as of Monday today. This is a week. This is always a week old, so we'll assume that this is dropping again because gold and silver mining stocks are headed lower, and which is telling us that likely there's more selling of gold going on here. And we've got NASDAQ tech stocks. They're back short here. And small caps increasing their short positions here as they think small caps are headed lower, which is interesting. If they thought small caps were headed lower, then they should be short large caps as well. But not seeing that there. They're holding on to their dollar position, so the dollar is running sideways, although generally they are backing off their dollar long positions. But this, as if it couldn't get worse, what we're seeing is a number of short contracts on volatility. VIX futures is almost or very close to back where it was before the big blowout in volatility. So what you have here is a market that is completely dislocated. You have everyone betting on higher stock prices. You have them shorting volatility, which is a bet on higher stock prices. You have them long oil, which is a bet on higher stock prices. And you have them short treasury yields, which is a bet on higher stock prices. But the speculative position on this is way wrong. I mean, look at this. They are as short as they were pretty much back in October, and then big blowout volatility move is going, if that happens, and it should, because when you get too many people on the wrong side of the market, some big players will come in and force it the other way, causing a short squeeze, which would unravel these positions, drive them higher, and bring the market down. So this is kind of some dangerous positioning. So for those who think the market goes higher, you do not get the market higher when you have pretty much everyone who is short volatility that's already short, and have everyone that's buying stocks to be already bought. And all this, you don't normally see stock markets go higher from here. Doesn't mean it can't, just means you normally don't. All right, so let's run through the markets. We've got, looks like about 6 minutes to do that. So S&P just pretty much sitting up here about 33 points from its all-time high, just kind of hanging out. Trading volume, here it is, very, very low. I mean, you can go back the last year, and it's pretty much not quite at the 1 year low, but man, it's low volume. And you have to go back to just some odd day back in August when nothing was going on. So let's continue on. Let's take a look at volatility. We see volatility. We'll zoom back out. We're seeing it short as if people were short back in, well, actually go back to 17. But anyways, very short volatility. Likely volatility is going to rise. If we look at the ETF, I mean, this thing could easily break through its December 2018 highs, and it's got some room to run because there's so many people short against bad economic data. That's the weird part, is the economic data is getting worse. It's not getting better. And people are acting as if it doesn't matter. They think the second half of the year is going to be gangbusters. Not when you're in this long deceleration of this money supply. Not going to happen. Looking at 10-year Treasury yields, now it did close as 2.58, so it did close below its 50-day moving average. Remember, rallies start when you cross and reconfirm. This will be 1-2 reconfirmations. So as this confirmation holds, you've got a run at the recent lows at 2.356. It's going to retest this and probably head further down. I mean, you can look back at some charts and you can see, you break through, reconfirm, lower. Let's go back up here. Break through, reconfirm, lower, reconfirm, lower, reconfirm, lower, reconfirm, and then get up here, lower. So the more times this thing touches its 50-day moving average, lower it goes. On to, let's see how much time we have left, 4 minutes. Gold miners. As I've said, big selling here. 2 days, 3 days in a row, almost 4 days in a row. Selling. The 50-day moving average is rolling over. Momentum has still positive on a year-over-year basis, but not for much longer. It's headed, actually we're on a year chart, so momentum has turned lower for the year just recently, last couple of days. And where does this tell me it hits? See, I thought this was going to be an area of support because you had some buying here, but it turned out, no, it didn't. There wasn't many buyers here really at all. This was a very weak bounce. So we're seeing selling come here. The next support level for GDX is right here at roughly between 2025 and 2050 per share. So you see you have this is acting as support. If it breaks through here, if these are not strong buyers right in here, and they may not be, then you're coming back down into this 18 to 19 range. You get another bottom in here, you've got a big catalyst for a market going higher. My hunch is going to be bottom right in this 19 to 1925 range. We'll see how that kind of goes. Right, a few more minutes left. Oil and gas stocks came up, touching right into this resistance zone. This is way ahead of itself, given the fact that we've seen crude oil inventory builds. We'll see what the API has tomorrow. Comes out about 1:30, so I will post it on my Facebook and LinkedIn pages for those who follow that, and we'll cover that again in our Wednesday video. Carrying on, let's see, we can look at physical gold real quick. I mean, it doesn't have the same action as the mining stocks, but it's telling you it's headed lower, broke through support that Peter Brandt and I had picked out and is heading lower. So it's kind of exactly what you think. And we know that the broad market is headed lower because wood or lumber prices are headed lower. We know Treasury yields follow this too. We see that crude oil follows this lower. So we know that, price of lumber is telling us that oil prices are headed lower. The broad stock market's headed lower. Now, what kind of surprised me today is this big move in the ags, and then we'll kind of maybe wrap up after this, is we saw this big break through the 50-day moving average, and it's kind of finding some support down here where this big volume moves are. So that tells us that the market's confirming that these people in here that were buying indeed bought. And so we'd like to see the price hold here and then get back over its 50-day moving average and make a run at it a second or a third time. So it'd be 1, 2, 3, how about a fourth time? Anyways, that's what we'd be looking to see. This gap now here has been filled. All the gaps up here have been filled. So we'll kind of see where this goes. But certainly the outlook for this sector is very bullish, but the market is very short at this moment in time. Let's see, we got 1 minute left. What do we want to go take a look at? How about Tesla? They had a bunch of their board members say they're not coming back. And apparently they get paid $7 million a year to be on the board. And if you pre-announce you're not coming back, and I don't know why, but a number of them did. In fact, I've now come to find out that the second highest ranking person in the Tesla Corporation was hired in 2016. Weird. So, but from a stock perspective, we can see some interesting things. Huge topping pattern in Tesla. Rumored is Elon Musk starts getting margin called somewhere under $240 a share based on what we can see across to the 50-day. retouch of the 50-day, this green line, retouch of the 50 days, confirming we're in a downward trend. It now needs to find support from these buyers right in, I mean, you could say it's between these two lines, but the real area of support is between 240 and 250. And if that breaks down, well, Elon Musk is going to get a short squeeze on his own stock, and he's going to have to sell a lot of it because he's borrowed and then borrowed against himself again. Never recommended for anyone to do that. Anyway, so that's our update for Monday. We'll be back with you on Wednesday, see what's going on in the markets. Until then, I'm Steve Van Metre. Bye now.